Hi, this video is going to be slightly different to usual. We will not discuss an individual altcoin. We will not look at just simply the market of Ethereum or Bitcoin, but we will talk about strategy. We will talk about the mindset. When does it make sense to sell? Because that question came up recently in our Telegram group. There was a question, when should we sell Bitcoin? When does it make sense in general to take profits? How should we approach this? Because obviously it's very hard to say at a certain point in time that we are high in price or that we are low in price and that we should sell here and buy here, right? Nobody can read the future. And so is this now cheap? Are we going to rise further? Is this now expensive? How should we decide this? What's a good exit strategy? Now, here's the way I think about this. There's basically two types of ways to deploy capital in crypto or in any asset for that matter. There's investment money and there's speculative money. And there's really a strong difference between the two. And this video is really to drive this home so that you have a clearer path on when to buy and when to sell something. So let's first talk about investments. What does investing really mean? I think it means putting your money into stuff other than cash to protect it and to grow it over time, to grow the purchasing power over time. Because say you've got a salary, you've got regular income. You save up, say, 30% of your salary. After 3 years, you've got 1 year of salary saved. Now, you don't want to keep all of this in cash, obviously, because of inflation. Every year, you will lose 5 to 10% in purchasing power, depending what you want to buy with it, right? If you buy just groceries with it, it's probably 5%. If you want to buy a degree or need it for medical expenses, it's probably larger than 5% that you lose in purchasing power. So you need to put the money somewhere. You need to park it somewhere. And you don't know how long this will be. This can be very long term. This can be 10 years, 20 years, 30 years. It can be basically for your retirement. And that's what I consider investing. And the targets of investing money are very different to the targets of speculating with money. And both have their legitimate places, but they shouldn't be confused. So you're probably familiar with the concept of portfolio allocation, with diversification. So you don't have all your money in cash, obviously, because of the inflation, but you also don't want to have everything in stocks because of the potential stock crashes that can happen, right? Stocks can go down 30, 40, 50% in a year if you've got really bad luck, right? If you buy during a large financial crisis, that's what can happen. And if you've got a lot of money stacked away, if you've saved for 10 or 20 years and you've got 5 years or 10 years of your annual income stacked away, you don't want to see this dropping by 50%, right? You don't want to have your 10 years of savings suddenly go down to 5 years of savings. So you need to somehow split this up. You need to allocate to different pools. And so you've got a little bit in stocks. You've got also something in property, maybe the house you live in. And then you also have something in precious metals, let's say in gold. You've got your emergency fund in cash. And then you've got crypto. So why do you do this kind of split up? It's basically to protect yourself. You protect yourself against inflation, so you're not a lot in cash, but you also protect yourself against a particular asset that might go down. There might be a property crisis at some point. There might be a stock market crash at another point. Gold might run out of favor. But it's very unlikely that all of those things will happen at the same time. And so you're always somewhat protected. And so how do you choose what to invest in? There's several things to look at. So first of all, you want to look at correlation. Correlation simply means how much do assets move in the same direction at the same time. So we are just in a crypto crash. So we see 98 of 100 assets, they go down. 2 assets go up. And so that means that crypto assets within the space, they are highly correlated. So you've got one asset and then you've got another asset and they are really highly correlated. And so when you then have a portfolio out of those 2 assets, say you've got some Ethereum and say you've got some Cardano, you have this both in one portfolio. Your portfolio line in the end will look very similar to only having one of those assets, right? It doesn't really matter even that much if you only hold Ethereum or if you only hold Cardano or if you hold both. Because in the end, when you combine them, you get more or less the same kind of return, the same gains or the same losses. That's high correlation. And you don't want this in your overall portfolio, right? If you've got 10 years of salary saved up, you don't want when the thing goes down that you're not protected. So a measure of protection is correlation. So you want the correlation to be low. You measure correlation coefficients between +1 and -1. +1 means perfect correlation, so the assets move in the same direction. -1, however, means that they move in opposite directions. So say we've got another asset and it tends to go the other direction usually. So we've got something like that. Now what you want to ensure though is that your other asset still appreciates over time. So this might not be the perfect example here, but this is just for illustration, right? So you combine those two in one portfolio, and what you want then is a portfolio line that doesn't fluctuate as much as a single of those assets, because the assets' price volatility, they cancel each other out. So you want something that appreciates over time, that has less price risk. That's what your overall portfolio should look like. So you want to look for asset classes that are lowly correlated. That's your target with investments. So you don't necessarily buy just what's got the best risk versus reward. You can forego some reward, some performance, simply because it's lowly correlated to the rest. So that's the argument for gold, right? Gold doesn't necessarily move in the same direction as the stock market. And so even though it appreciates less over the years, you still might consider owning some, simply because when the stock market completely collapses, your gold still might hold up somewhat. And so you're not in complete financial ruin. All the savings was not for nothing. You're somewhat protected. So gold can be regarded as an insurance policy. Now that's a lot of theory. Let's look at crypto, because that's what you came for. This is a crypto channel. This is the 2-year correlation coefficient of daily returns between Bitcoin and the S&P 500. So we're looking at how much do the prices of the stock market, of the general stock market, move in tandem with the largest cryptocurrency. And so when you've got a correlation coefficient of 1, they always move in the same direction. When you've got a correlation coefficient of -1, they always move in opposite directions. So your best portfolio diversifier has a very low value on this chart. And we can see that Bitcoin is pretty lowly correlated with the S&P 500. It tends to increase over time. So before we were pretty much completely uncorrelated to now being at around 0.2 correlation. This is still pretty low. So crypto still is a very, very good diversifier for your stock portfolio. Compare this, for example, with Apple to the S&P 500. So you've got, say, an S&P 500 ETF, a Vanguard ETF, something like that. And now you buy an individual stock to diversify away from your overall broad portfolio. Maybe you think Apple might outperform, so you want to get a bit more reward. But you're also doing this for diversification purposes. In this case, you're not doing too great of a job, because Apple is correlated with the S&P 500 by 0.7, by a coefficient of 0.7. So I know this example is probably not the very best, because Apple is part of the S&P 500, but just tries to bring this point home. If you stay within an asset class, within the stock market, you're unlikely to achieve a lot of diversification simply by picking different assets within the asset class. So this is true for crypto. So if you just have a crypto portfolio, it doesn't make a big difference if you just buy Bitcoin or several cryptocurrencies in one portfolio, in one basket. And the same holds true for stocks. If you buy, say, 4 or 5 stocks and you add another 6 stocks, 7 stocks to it, you're unlikely to gain a lot of diversification benefit from it. If the stock market crashes, all 5, 6, 7 of your stocks will crash at the same time. At least that's very likely. But it's not so likely that when the stock market crashes, that the crypto market is going to crash as well, or the other way around. When the crypto market crashes, that the stock market crashes. I mean, look at this. Bitcoin has lost like 15% yesterday, and the stock market didn't bat an eye, right? The stock market stayed stable. So the correlation between those two asset classes is very low. And so that's why crypto is a really, really good diversifier. Owning Bitcoin for the long term as an investment, simply to park your money, not to lose to inflation, simply to protect yourself against property crashes, precious metal crashes, stock crashes. Simply for that reason, it does make sense to own Bitcoin and not sell it. So the idea here really is asset allocation. You want to keep your money in something, right? You have to keep it in something, and you don't want to have all of it in one thing. You don't want to have all of it in cash. You don't want to have all of it in stocks. You want to have this in different things, and crypto should be one of those things. You are not going to sell your entire stock portfolio when stocks are high. You are not going to sell your house because house prices are high. And so you shouldn't be selling your Bitcoin because Bitcoin is high. You should keep it as a diversifier in your portfolio to cancel out price volatility and to still benefit from the long-term gains. Now, that being said, is there a time to sell Bitcoin? And the answer is yes, but it's not when prices are simply high or when you feel like the market is overheated. That's not the reason to sell an investment. The reason to sell an investment is for reallocation. So when you have this allocation of different assets, you need to think for yourself, what percentage of your overall portfolio do you want to have in property? What percentage do you want to have in stocks? What's the size of my emergency fund? And the same question you should answer for your crypto allocation. How much of your wealth do you really want to have in crypto? Is it 5%? Is it 20%? Answer this for yourself. What's your target allocation? And that's obviously depending on your age, right? If you're close to retirement, you probably don't want to risk as much. It's also related to the size of your net worth versus your regular cash flow. Because say when you've got only half a year of cash flow saved up, you can risk much more to invest into crypto, because if it really falls by 50%, it doesn't really matter that much, right? You've got this recovered in like half a year. That's very different though if your net worth is already very high and you're losing like 5 years of cash flow simply by dropping a lot in price. So answer these questions for yourself. Figure this out. Also, psychologically speaking, how much volatility can you digest? Are you comfortable losing a lot of your net worth, of your saved money, in the potential case that one of those asset classes goes down? So think about that. What's your target allocation for each asset class? And once you've got that, you need to rebalance. So that's why I say target allocation and not allocation, because the prices of these things, they fluctuate, obviously. Things go up and down all the time. And what goes up and down most of all of those assets, it is crypto, right? Look at this, Ethereum, after the last bubble, how much did we drop? 94%. How much did we go up here? 32x. So these movements, they are massive, right? And if your target allocation to crypto is, say, 10% of your overall net worth, when your crypto doubles or triples in value, then you've got to sell some. You've got to rebalance, because your crypto might go from 5% to 10 or to 15%. You got to sell some and you got to put it to all these other assets to restore your optimal target allocation for each asset class. So that's when you sell an asset. That's when you sell Bitcoin. It's solely for reallocation, for rebalancing of a portfolio. That's the long-term investment strategy that I personally follow. Now that's it for the boring part of this video. Let's talk about speculation. Speculation is something completely different. Speculation does not focus on correlation between assets, on canceling out risk from each other. Speculation is something very different. And I want to drive this home by not looking at crypto for a second, but at looking at something that's maybe more relatable at property. So you might buy a house because you like the environment. You like this house. You think it's very easy to rent out maybe. You think the tenants there will be really nice. Maybe your rental yield won't be that high, but you won't have a lot of headache renting this out to well-employed people. And so you buy this property for the long term, and maybe at some point in life when you decide not to work anymore, you will simply use the rent income to pay for your retirement. So that's an investment. Now, contrary to this, you're browsing all those different houses, and what you find is in like a really shady neighborhood, you find a house that has like cracks everywhere, that's really ugly, but it's incredibly cheap. You can buy this way below what this house is actually worth. But the problem is you will deal with a lot of headaches once you get in those drug dealers, those people with unstable employment. You actually don't really want to own the house. The only reason why you're interested in the house is because it's so cheap. And so what you do is you speculate. You buy the house, you fix it up, you increase the price, you increase the value of this house. You're able to rent it out once to a person that can afford now the higher rent. So the rental yield on this property suddenly shoots up. And so you bought something cheap, you can then flip it, you can sell it for a much higher price, and then you've got a speculative gain. You made money by taking advantage of mispricing in the market, a temporary mispricing. Somebody neglected their property, you picked up the pieces, you made your gain, you bought it, you fixed it, you sold it for profit, short term. See how these things are very different? The way you approach the investment, your investment horizon, the things you look at when you buy, they are very different. When you buy something in a nice neighborhood, it can be just fair value, fine enough. You just buy it for long-term appreciation over time, for little headache, for retirement. Speculation and fixing up is very different. It's taking advantage of short-term price distortions, of making money in the moment, and then potentially use that money to buy a nicer house, right? A house with nice tenants where you don't have headaches, that you can keep for 20, 30 years. So that's for property. And the same goes, in my opinion, for crypto. What are those ugly houses with potential cracks that might have a price distortion? It's the altcoins. At least it's the altcoins that are very risky. That's like maybe market rank 50, 100, 200. If you go really extreme on this and you want to have a lot of cracks and you want to have a lot of price distortion and make $100 out of $1, then you're going to go into the Shiba Inus of the world, into the safe moons, if that's your thing. But that's speculation. That is not investment. And the reason why it's not investment is because it's unlikely that you have the conviction that your baby Dogecoin is going to stay relevant in the next 20 or 30 years. Or if you do have this conviction, then, well, I don't know what else to say. So you're buying this for the quick flip. You're buying this because you think now it's not yet popular. Maybe a lot of social media hype will happen. Maybe a few influencers will push the price. And so you buy this just early on the hype, hoping that the wave will carry on and you can sell it to somebody who was not as quick. That's speculation. And there's nothing wrong with this if you really know what you're doing. There's nothing wrong with buying ugly houses and selling it once it's fixed up. It's a totally legitimate way of buying things, but it's a different approach. And so when you buy these things to sell them later for a higher price, and you're speculating on a price appreciation, on a short-term price appreciation, you now have different criteria for getting into the asset and for exiting the asset, for selling. You're really not looking at correlation. You're really not interested in, does this altcoin move at the same time as Ethereum? You're really not interested if this house is going to fall in value if the overall market, the overall property market goes down. You're interested in, is this house really cheap? Is this altcoin really cheap? And so you're maximizing your reward versus your potential risk. How much investment do I put into this altcoin and what kind of return can I expect? And now you just have to look at what makes an altcoin risky and what brings the potential reward. You have to balance these somewhat out. You need to figure out, how can I get the best relationship between the two? So the potential reward is obviously looking at market cap. If you've got something with a very large market cap, say Cardano, it's probably not going to 10x very quickly. So if you're looking for high reward, you have to look at lower market cap coins. And if you're looking at price predictions, how high can it go? Just look at comparable coins where you could see this. Say you think your altcoin can go from place 100 to place 30 within the crypto space. You could just look at what's the market cap of the coin at 30, what's my current market cap, divide those two numbers, and then you've got a multiple that you can use to estimate your potential reward. Now, trading lower market cap coins obviously also comes with some risk, but these risks, they might not be completely related in a linear fashion to the market cap. So is the altcoin at place 200 really that much more risky than the altcoin at place 100? Maybe not, but it does have double the potential. So what you need to figure out with those risks here is, can you eliminate the possibility of a complete loss, of falling for a scam? Because that's what you really don't want. You don't want to buy a rug pull, right? And you only have this risk with smaller cap coins. So one way to eliminate this risk is not to go too low, obviously, on your market caps, not go to place 1000 where you've got maybe 1 million of US dollar trading volume per day. Actually, let's not make this too theoretical. Let's really look at this. Coin market cap. Let's go to place 500. Here, 4 to 500. Now we've got market caps in the 100 millions. And we can see here the trading volumes. Do you really want to buy something with a trading volume of 170K in the last 24 hours? Probably not, right? You can move the market really quickly here. And there just needs to be one person that sells 50K in this thing and you've completely lost, right? So you can look at this. You can look at trading volume. You can look at the market caps. And then obviously one way to also eliminate risk is fundamental research. Look at the team, look at what they've put on their website, check if there's still development happening, maybe check their GitHub repository, things like that. You can reduce risk in that way. Another way to reduce risk is to look at the general crypto market, right? At the crypto momentum. How, for example, is ETH currently doing? How is Ethereum's momentum doing right now? If the overall crypto market tends to go up, that's when you want to be in altcoins. When the Bitcoin dominance tends to go down, that's when you want to be in altcoins. Because even though your specific pick might not be ideal, if the overall tide is going up, you're likely to make gains as well. So what I personally do is I speculate in crypto only when I see general momentum being positive. And what I look at is Ethereum. I have my moving averages, the 23 and the 39-day moving average. There are separate videos on this on my channel. Feel free to check these out. But that's what I use to gauge the general momentum. When we are above those two moving averages, I think we are likely to go further up. And I also look at Bitcoin dominance if it's going down, and that's currently the case. So I do think we are still in an altcoin rally right now, and so it does make sense to speculate. But once this turns around, once Bitcoin is gaining ground again, once Ethereum is losing in value, I am not going to hold onto my altcoins simply because the general risk goes up a lot in bear markets. I don't think it's very easy at all to make money in altcoins if general momentum is bad. Here, look at a solid project such as Cardano. During the last crypto crash, Cardano went down by 98%. You basically lost all your money in a solid altcoin project. Now, who knows what happens with even the Dogecoins of this world, right? So you don't want to be in an altcoin. You don't want to hold it during a bear market if you can avoid this. And so that's how I see altcoins. I only want to be in them if general momentum is positive, and you need to have a certain framework to gauge for yourself. Are we in a bull or are we in a bear market? If we are in a bear market, simply get out, sell that ugly house, cut your losses, because obviously the flip didn't work. But you know, no speculation always works, and that's just the way how it goes. Nobody makes profit with every single trade. This video was a little bit different to usual, so if you enjoyed this content, please give this a like. I can foresee that YouTube is probably not going to share this content too much. It's not really searchable content, so I made this really for the current subscribers, for the people that like to look beyond simply timing a single altcoin, that like to get some theory around everything. So if you enjoyed this, give this a like. Maybe YouTube will help to at least share this a little bit. And for the very unlikely case that you stumbled upon this video without being subscribed yet, now is your chance to do exactly that. I publish a video every single day. And last but not least, we've got a Telegram channel. We are now more than 500 people. We like to discuss crypto over there. We like to talk about altcoins or the general market. It's completely spam free, so feel free to join us. You can find us either by clicking the link in the video description or by searching for Bitcoin Strategy Channel within the Telegram app. See you next time. Bye bye.